I always tell people start small. That's what we did. There is a saying out there that I think is absolutely wrong, and that is if you have a good deal, the money will come. I think that's terrible advice.
Hey guys, welcome to another episode of A-List Conversations and the Real Estate Investors Group. And today I have Matheson,
Matheson.
and he is going to be talking about multifamily today. You know, he's the co-founder of Matheson Capital. He has 100 million in assets under management. He has a master's degree in real estate development from Columbia University, and he used to work at investment sales at Marcus and Millichap. So we're going to be talking a little bit about how his journey from out of college to being now in in a GP partnership and doing some multifamily investments. So Will, thank you for coming on. How you doing?
I'm doing well. Thank you for having me.
Thank you. Will, it's exciting to see, people like yourself, just doing a lot in multifamily space. And I really want to know the story behind Matheson Capital. How did that, get to be, get to
So,
come?
so the company really started when Evan, my twin brother and co-founder at Matheson Capital, we were brokers for Marcus and Millichap in Raleigh, North Carolina.
Yeah.
And we had a client with a 1031 exchange. They split their exchange. So instead of buying one property, they bought two. And they ended up
Yeah.
having $1 million equity shortfall on. They had $1 million equity shortfall, so they couldn't buy the second deal because of the way 1031 exchanges work. They were going to have a massive tax liability. So our senior broker at the time essentially came to us and said, "Hey, go find a hard money lender, someone who can get these guys $1 million." We sat there and thought, yeah, we know their real estate portfolio. We know these guys are worth eight figures. Let's put a hard money loan on the property. We could raise the $1 million. We raised it. We put it as a first lien on one of their other properties, and we held that loan for about 16 months. That is how the company started. It's the only loan we've ever done. Um, and then in 2000, we held that from August 2015 through December 2016, and then starting in January 2018, we started buying real estate. Bought a duplex in Los Angeles, and 15 acquisitions later, here we are.
That's awesome. That's quite the jump. So how did you what caught your interest when you first started, in real estate? Like, why did you pick real estate as an investment vehicle, and why not something else?
I was a broker at Marcus and Millichap, so my job entailed working in real estate consistently. So that was obviously a key component. I have a lot of family who's worked in real estate. My uncle,
Hmm.
my grandfather, my aunt, my mom, they've all worked at CBRE at one point. My brother and I were at Marcus and Millichap. I generally believe in efficient market theories on the stock market. So, I was never going to do better than the S&P. So if I wanted to actively invest in anything, real estate was the way to go.
Okay, that's awesome. Yeah. So it was in the family. I love it. So how do you navigate obtaining $100 million in assets under management right now?
So one of the keys to what we did is we very much focused on starting small, buying smaller deals. Like I mentioned, our first acquisition in January of 2018 was a 2 unit property. The next property was 6 units, then another 6 units, 15 units, 24, 32, 32. We were buying a lot of small properties. We were holding them for short amounts of time so that we could, do a lot of value adds, sell them, and deliver returns to investors. Because when we bought our first property, and when I say we, I mean my brother and I, we were 25 years old. No one was going to give us tens of millions of dollars. This is real estate, not tech. Um,
Yeah.
so we said, let's start small because it's the least equity we'd have to raise. Let's do some quick turnarounds, take a deal from start to finish. That'll build a track record of success. It'll build proven returns. We can show new investors those proven returns. We can go back to our existing investors, ask them to reinvest with us. And that was our strategy. I mean, so far, like I said, we've done 16 acquisitions, 14 of them at the lead, but we've sold seven of our acquisitions already.
Okay, that sounds great. So you've been investing for how long?
We bought our first property in January 2018.
January 2018. Okay, so it's been about 6 years. That's
Yeah,
awesome,
a
man.
little over.
Yeah. And currently, you're investing in the Southeast, right?
Correct. We now own in North Carolina, South Carolina, and Georgia. We're based in Charleston, South Carolina. So we
Okay,
like to stay in
cool.
the Southeast.
So how do you identify potential multifamily investment opportunities in your market?
We primarily work through brokers. Typically, even if it's coming through a broker, we're not typically buying marketed properties just because we don't want to go through a competition with 20 other offers and go through multiple rounds, best and final. We've done that occasionally, but the majority of our acquisitions have been off-market deals through brokers, which seems like an oxymoron, but it's not. It's just a non-marketed property.
Got it. So you're mainly going after pocket listings from brokers.
More or less, yes.
Yeah, yeah, that's awesome. And so what are some of the things that you identify that check the boxes for you to look further into an investment opportunity in your market?
Well, it's changed a lot over time, as you can imagine, just based on the sizing. I was detailing, a 32 unit property used to be our biggest acquisition. And just this past Friday, so May 10th, we acquired a 248 unit property in Savannah, Georgia.
Hmm.
But, historically, we wanted small properties where we thought we could add a lot of value within a 1 to 2 year period. Lately, we've really been, and by lately, I mean 2023, 2024, we've really been targeting, let's say, either loan assumptions, because if you can assume a loan that someone originated in 2020, 2021, that has 7 or 8 years of term at interest rates that you cannot get today, if you can do something like that, you can get a cash flowing property, which is almost impossible with new debt. The other
Hmm.
area we're really looking is just the distressed seller, the quintessential distressed seller, where they bought it at the peak of the market in 2021. They had floating rate debt. They're facing foreclosure. We had an acquisition in October that fit that criteria. We paid 91 a door, where they bought for 106,000 a door in 2021. So it's either
Wow,
distress or loan assumptions.
wow, that's great. So you close over 50 transactions and $140 million worth of deals in Marcus and Millichap. What kind of insights and experience did you get from that have helped you now in
The
your
number
investment journey?
one, the number one thing I got at Marcus and Millichap was the ability to deal with a lot of rejection. That's the thing about, I was a retail broker primarily, net lease deals, strip centers. So 99 out of 100 people you talk to had no desire to sell. They did not want to speak with you. You just got told no a lot. And so that's always fun to deal with in your first job when you're, 22, 23 years old. But
Yeah.
it taught me a lot about persistence, how to close. I mean, shockingly enough, we have a lot of conversations with equity investors where it might take us, some people come in and they want to invest on the first deal they see. Other people, it could take years of earning their trust and just biding time with that. But the funny thing is, working at Marcus, we didn't do a lot of multifamily. It was mostly retail. There's not a lot of transition between retail, like buying a triple net lease Taco Bell and buying an apartment complex. We didn't really have a lot of the clients we worked with at Marcus come over and invest with us in our current capacity. But, sales skills, persistence, those are really the key things.
Yeah. Yeah, that's amazing. I did a mastermind. I was in a mastermind with Manny Koshman. He's done 1 billion in real estate transactions. He mainly focuses on retail and office. And so I know a lot about the retail sector because he does a lot of value adds in that sector. Um, what was the reason that you didn't stick with, retail, and you actually went into multifamily when your investing journey?
So obviously, a lot of people are experiencing that this is not true right now. But
Hmm.
we didn't want to do net leased retail because you're not really, it's hard to add value to investors in the net lease space. You know, theoretically, you raise money from investors to go buy a 6 cap, 15-year net lease deal. Well, what do you do for the next, I mean, the next 15 years, you're just distributing cash flow or something like that. So that wasn't an avenue we wanted to go on. And that would leave you with multi-tenant properties, strip centers, shopping centers, things like that.
Yeah.
And the reason we didn't want to do it was because of the leasing risk. You know, you have a vacancy, one big vacancy in a retail property can really torpedo your entire investment. So we went into multifamily because we thought it would be the hardest thing to mess up and would be the hardest thing to lose a lot of people's money on. And we've never lost anybody's money. But I made the joke at the beginning because obviously a lot of people who bought in 2021, 2022 with floating rate debt are in a lot of trouble right now. But our outlook was, look, if we do value add multifamily, we can there's a provable path to grow the revenue. We're a fixed rate debt borrower. We don't use floating rate debt. So we thought there would be a lot of stability there. And we've mostly been correct on that.
Okay. That's awesome. So how do you, when you're doing acquiring properties right now, how do you cover yourself from the risk that's involved?
Well, the biggest way I mentioned, when we're acquiring properties is in going through the process of buying them or after we own them.
Yeah, when you're buying them, I know that you said you were doing, assuming loans. But do you also have, do you do interest rate caps or something like that so that you don't end up in the same situation that your sellers are, distressed situations?
So because we don't use floating rate debt, we're assuming fixed rate loans. So, yeah. And I mean, one of my things is, people are very focused on taxes. They're very focused on insurance. They're very focused on their operating expenses. Your single largest expense is your debt. Mm-hmm. Your debt payment. So we like to we use fixed rate debt because we like to know going into a project that, hey, my largest expense, it's not going anywhere. I know what it's going to be. Obviously you'll still have a balloon payment at the end of the day, but we like to be cautious in that sense. And fixed rate debt, we think, is a great way to do that.
Yeah, absolutely. So I'm curious to know this. How has a master's degree in real estate development from Columbia University influenced your approach in investments at all?
That's a good question. I mean, that's a tough question because I have a lot of classmates from the program who, when they went into real estate, they went to, name brand firms, bigger shops, things like that. And those who went out on their own and wanted to start their own companies, a lot of them did go out and say, I want to buy $20 million deals. I want to buy $30 million. Like, they wanted to go for bigger stuff. Evan and I, when we were leaving the program, our outlook was, like I said, we're 25, 26 when we graduated. We're not going to be able to raise millions of dollars. Maybe we'll be able to get there one day. We've built a great network, et cetera, et cetera. But we didn't want to, we were just very cautious about it. Like I said, the program's offered us a really great network of people to go to. On our most recent closing, the Savannah project I mentioned, I think I worked with 6 other people from the program, either as partners or investors. So it's been a great program. I really appreciate it. But as to how it's shaped our outlook, I guess the number one thing it's done is it kind of gave us more exposure into just the extent to which you can scale, the extent to which growth is possible, all the different ways you can raise money. I know other people have done it other ways, but it was really helpful for us coming out of a brokerage background.
Yeah, that sounds great. So let me ask you this. What are some of the benefits that multifamily investing offers to some of the people that you're working with as investors?
So one of the things I like most about it is the diversification aspect. As opposed to retail, as opposed to industrial, as opposed to a lot of other things, in industrial, you may have 1 lease. In retail, you may have 5 leases. In a multifamily property, you can have hundreds of leases. So it provides a good diversification against cash flow, or to provide consistent cash flow. If one tenant leaves, you don't lose 20% or 100% of your revenue. There are certain lending advantages that favor it. Fannie Mae, Freddie Mac, industrial real estate doesn't quite have a lender like that. And a big one, a big one is, I think, if you're smart about it, if you're cautious, it has so many demographic factors working in its favor that I think it provides a lot of upside while also being incredibly safe. And when I say demographic factors, we invest in the Southeast. That's these are massive growth markets. A lot of people are moving from the Northeast, the Northwest, the West, the Midwest, the South. So the Southeast has a lot of population growth. People are getting married later, which means they're typically renting apartments for longer. So we're providing housing to those people. And, people like to make fun of California. They like to make fun of New York for being so anti-development, anti-real estate development in a lot of ways. But just nationally speaking, it's very hard to develop real estate. It's very cheap to stop it. It's very expensive to build. And if it's difficult to build real estate, then investing in existing real estate I find to be fairly beneficial. The barriers to entry are high. It's tough to do. So for lending reasons, stability reasons, demographic reasons, that's what the investment offers. I mean, also tax reasons, interest appreciation, things like that.
Yeah, yeah, that sounds great. What kind of returns are, your projected, returns looking like? And and what are investors, how do they like to see that from you?
So I'm gonna give you roughly the same answer that Jonathan Twombly gave you. I don't know what the difference in publishing dates will be, but people are typically looking for high teens, low 20s. Maybe some people, I know a lot of people offer 15%. It also depends on the asset class. For core funds, investing in Class A, downtown, major markets, people will often take lower rates of return. But when we're doing a project, we're typically trying to offer investors north of 18%, preferably in the 20s.
Okay, cool. And what is the structure that you have with your investors? Is it a preferred return, and is there a split afterwards? What kind of things do you have going on?
It varies deal by deal, but typically we're offering a preferred return that's ranged everywhere from a 7% preferred return to an 11% preferred return, just depending on where we are in the market. Obviously, 2021 equity was in a lot more demand. We've worked with some larger groups and private equity firms where, because they're writing larger checks, they can throw their weight around to demand better terms. So we've gone everywhere from 7 to 11%. 20 or 30% promote to us on top of that. And sometimes we'll have a hurdle that if we really knock it out of the park, we can take a 50% promote, but it varies by deal.
Okay, cool. So what are your favorite value add strategies to find in a multifamily deal?
Well, there's really only a couple ways to do it. One is to, renovate units and grow rent. The other one is to improve expenses, management efficiency, and sometimes, like Jonathan said, you find the golden one where you don't have to change a thing. The rents are just too low. But obviously everyone likes the one where you just walk in, all you have to do is change the rent on apartments.com and you're grossing up the NOI. Everybody loves that one, but
Yeah,
we traditionally do a lot of work in just renovating units, traditional value add.
gotcha. So renovating units and raising rents, basically. Yeah,
Yeah, I mean,
that's
nobody
cool.
really, not a lot of people like the 1970s apartment vibe anymore. It's a little dated. People prefer something a little newer.
hmm Yeah, yeah, totally. Yeah, that is interesting. And what are some of the strategies you do to get investment capital from investors? Where do where do you get around? Where do you find them? How do you build trust with them? And how do you eventually get them to invest with you?
So we use a lot of use a lot of different strategies. We try to be active on social media. Evan and I, we're mostly active on LinkedIn. It's just the nicest social media app. Nobody's really rude on that platform. And you have, really good demographics. We've found quite a few investors on that. We get a lot of referrals from existing investors, but we also put our Marcus and Millichap skills to use. Sometimes we just cold call private equity firms. We just call them and say, hey, look, I know you invest in projects. We do projects like this. Let's connect. Let's join our mailing list. Let's stay in touch. All sorts of different ways.
Okay, that's cool. Yeah. So how important is it to you to build a brand in order to get investment capital, and what do you see yourself becoming?
Building a brand is a tough one because I know so many firms out there where you would never know they exist. You've never heard from them, but they have a really great reputation within their investor group and they have a rock solid track record. Building a brand, so there's two ways you can look at it. You can look at it as building a track record of success that gives equity, when equity looks at what you've done and they see what you're doing, that gives them a lot of confidence and they want to invest in that. The other way to look at that is you can build a brand and you can have investors, primarily retail investors, coming to you. We mostly, there are groups that do that. They have that sort of pull. We obviously want investors to come to us, but the primary way we try to build a brand is just by continuing to execute on our projects, deliver good returns for our investors, and build a track record that we can show to new prospective investors and say, this is why you should trust us. That's why when we started, like I said, we were doing shorter term holds. We didn't want to tell people, hey, look, we own, we've made our quarterly distribution every quarter for the last 12 quarters. Not that that's a bad thing, but we wanted to say, we have gone start to finish, full circle, realized returns for our investors. That is why you should trust us. Look at the NOI growth we've generated. Look at the returns we've generated.
Yeah, that makes sense. Do you employ any kind of investor dinners or webinars or anything? Do you have a newsletter or something where you keep in contact with them?
So we do publish a monthly newsletter. We do publish a monthly newsletter. Being based in Charleston, we do have a good amount of investors in this market, but we have investors from all over the country, including, outside of the country as well. So not a lot of people want to make the trip down to Charleston just to meet us. They're happy for the phone call. So not a lot of dinners. Webinars are something that we have not done historically, but we're looking into. But every investor we have, they have my phone number, my brother Evan's phone number. We're very easy to access. We publish a monthly newsletter, and we're always available for questions.
That's amazing. So talking about you and your brother, what kind of differences do you guys share? And, what kind of things do you work on, like separately than,
So since we've been doing this, we always wanted to divide things, to have a fairly clear divide so that we weren't redundant. So very early on, Evan is a phenomenal financial modeler. Every job he's ever had, I think he's reworked their financial models essentially from scratch. So very early on, we said Evan's going to do all the underwriting on these deals. That way there's a consistent standard. He won't underwrite something one way. I won't underwrite the next property the other way. So he was always underwriting. I was always handling a lot of the legal work. I was primarily interfacing with the brokers. So there would be one point of contact, less confusion. One guy says something to Evan, the other guy says something to me. There could be miscommunication. So we wanted to streamline that as much as possible. We both spend a lot of time working investors. He has some of his investors. They're all our investors, but he's the primary contact for some investors. I'm the primary contact for others because real estate's a very capital intensive business. You need everybody looking for new avenues for investors.
Yeah. Okay, that's cool. What do you, for operations, do you happen to partner with operations, or do you have operations in-house?
So we partner with a group out of Charlotte called Stintino Management. It's actually somebody I met through the Columbia program back in 2017, 2018. So we've been working with him on half a dozen or so assets.
Okay, that's cool. That's incredible. Um, let me ask you about you and your relationship with your brother, and the fact that you both took the same route, you know, of going in real estate. How has your brother and you know, developed a relationship that is actually a fulfilling and mutually beneficial relationship?
Well, I mean, you know, we're twins. We've known each other our entire lives. So I feel like it's always been, you know, reasonably fulfilling and mutually beneficial. We're best friends. We have very, very, very similar interests. So we can talk about work, we can talk about football, we can talk about just about anything. So honestly, I couldn't ask for a better partner.
Yeah, that's awesome. And so the plan was always to do something together. And
More or less, yes. We always wanted to work together. We went to different undergrad. We went to different schools for undergrad, but and he got his first job. It was in New Jersey while I was here in the Carolinas. But very soon, he was working for Marcus and Millichap in New Jersey. I got a job with Marcus and Millichap in North Carolina, and must have been within 4 months of me starting at Marcus and Millichap in North Carolina, he left New Jersey office. He moved down to the North Carolina office to join our team.
that's cool. Yeah, that's cool. Awesome. So yeah, this is very interesting. What do you do on your, I guess, like, what's your workflow when you have a deal that's under contract? What do you do, you know, to make sure that the business plan gets executed and you're on the right path?
There's a lot of different things there. So while we're under contract, I mean, you obviously have to perform the um, physical due diligence, title, phase one, survey, all of those items. But you have to spend a lot of time raising equity, or very little time, depending on how efficient you are. So that's obviously the front end, and that just becomes our primary focus for however long we're under contract. It could be 2 months, 3 months. Our most recent closing, being a loan assumption, took us 6 months. Those are fun. Um, Loan assumptions are tough. They're very time
Yeah.
consuming. But as soon as we buy the property, you know, due to our partnership with Stintino, we've had tremendous levels of success. They know how we like to do things. So they do an excellent job in terms of renovating the properties, managing the properties, and we have Corinne on our team heading up asset management. So she does a great job supervising that, or monitoring, supervising, however you want to phrase it, but just tracking that on our end of things.
Okay, that's cool. Um, how has mentors taken a role in your life? Did you seek out a mentor early on, or what's it been like for you?
I wouldn't say I've ever sought one out, which I know seems shocking, but I went to the Columbia program because a family friend had gone to the program and spoke very highly of it. I was actually just emailing him earlier this week. So, you know, you could say he's a mentor, and that was obviously very helpful. I think the program was really great. One of my professors from that program I've gone on to work with half a dozen times. I consider him to be a mentor. One of my earliest investors um, is very experienced in real estate, decades more experience than I have. Very early on, I would send him our investment memos. You know, here's the projects we're working on, and here's our plan. He would print them off and mark them up with a pen in front of me, telling me how I could make them better. But it's not like I ever sought any of these people out. They've just kind of come to me naturally through the course of life. But they've obviously had a huge impact. I mean, you know, real estate's an industry where a lot of gray hairs, I feel like, help you, and I'm painfully short on those for the time being. But just give it time; they'll come in.
Okay, well, maybe if they're listening to this podcast, they can reach out. That's great. What would you say to someone that is looking to get into the multifamily space? Um,
So I always tell people start small. That's what we did. There is a saying out there that I think is absolutely wrong, and that is if you have a good deal, the money will come. I think that's terrible advice. It depends on who you are. The last guy who said that to me, I asked who told him. He said 55-year-old. You know, what did he do? Oh, he's a former Silicon Valley CEO. Like, well, yeah, of course that guy can raise money. He was a CEO in Silicon Valley. We started out small because we didn't have the network to raise the capital. We didn't have any of that. So if you start with smaller properties, the loans are easier to get. It's less equity to raise. The market is typically less efficient in that area, so you can probably improve management more easily, do renovations, improve rents more easily. But starting small, I think, is really, really big. And if you're really set on growth, I would say do what we did: do shorter term holds, take a deal start to finish. Uh, you know, if you're buying a 20-unit property, hopefully 3 years from then you'll have outgrown it if you really want to scale up quickly. So you don't want to be locked into that 20-unit property for the next 10 years. You want to have flexibility in your debt. You want to get in, get out, build the track record, earn trust from investors, find new investors. Those are a few things.
Yeah. Yeah, that is amazing. When it comes to, let's say, what is a particularly challenging experience that you've encountered in the multifamily space, and how did you navigate it?
Well, I mean, COVID wasn't fun. I
Hmm.
will say that COVID wasn't a lot of fun, but no, we actually just had a really tough experience on our Savannah acquisition several months into the process because it's a loan assumption. It was a Fannie Mae loan assumption. Your investor roster often has to be approved. If anyone has more than a 25% interest, they become a beneficial owner. That subjects them to Fannie Mae review. And several months into the process, Fannie Mae came back and said, you cannot use this investor who is offering us millions and millions of dollars on the project. It was an incredibly tough setback on that. We had to extend the contract. We ended up having to replace 50% of the equity, and then we lost another investor. So we had to replace another 25% of the equity. It was a really tough 7 weeks. But that's part of what happens. I mean, people sign up to work with you. Sometimes things happen, they get in the way. I know this is overly vague, but just from a capital raising perspective, you just can never know enough people. You never really stop working until the deal's closed.
Yeah. Yeah. When it comes to your typical day, what is this like? What's your schedule look like? What do you do?
So I'm typically up at 5. I like to run in the morning. I barely see the sun. I'm partially kidding. But we start, we have our team in the office at 8. We do a morning meeting, talk about what's ahead, where we are on certain deals. And then, I mean, every day is truly different. I wish I could tell you I have a set schedule. I need to have, I want to have more of a set schedule, but this day we have to go tour a property. This day we're discussing offering on this project. There's a fire to put out over here. There's a fire to put out over there. I mean, we have about 8 or 9 assets in our portfolio at any given time. We're trying to buy a new one, sell an existing one. It's not like being a broker at Marcus and Millichap where I know I'm going to put out 50 calls a day. It's not like that. There's something new every single day. Something always needs attention.
Okay, cool. So when it comes to your team, like what's your structure like? So do you have an investment committee? Do you have analysts? Like who's the one that who's looking at deals and who's reviewing them, and
Well, we're a 4-person team. There's me, there's my brother Evan, there's Corinne who heads up asset management, and there's Alex who handles a lot of our initial underwriting, acquisition work, things along those lines. Because of the size of the firm and the way it's set up, the investment committee essentially comes down to Evan and myself. We say, do we like this deal? Let's do it. But like I said, Corinne primarily handles the existing properties. Alex primarily, we work together to find the newest opportunity, see what we like, things like that.
Okay, cool. Um, do you have any plans for expansion?
As far as the
When it
team or as far as markets geographically, what do you mean?
when it comes to the team, do you want to bring on more people or?
Not anytime soon, not anytime soon. The market's fairly slow right now. There's not a ton going on. We have, Corinne can handle all of our existing portfolio. There's just not a lot of properties available, so it's not like we have more properties to analyze than we are capable of doing. So we're happy with where we are currently.
Gotcha. Yeah. So sounds like the constraint is really deal flow there. And so when it comes to the markets that you're looking at, how is it that you pick a market, for example? What are some of the criterias that you do when you went in firsthand?
So the reason we're invested where we are, so I'm originally from South Carolina. I went to college in Georgia. My first, adult job was in North Carolina. And we like those markets. It also is really great that we know these markets, we like these markets, and it's great that they're some of the most in-demand markets in the country. For us, we're typically in or around major MSAs. That changes a little bit if we think there's a really good opportunity. But supply and demand, population growth, we try not to overcomplicate things. If a city has a shrinking population, the odds are I don't want to invest there. The
Hmm.
city has great jobs growth, like, say, Savannah, Georgia. We're interested in investing there. If it has big industrial growth, one of our 2023 acquisitions was in Asheboro, where Toyota, like Asheboro is a small town in North Carolina, but Toyota was investing billions of dollars in the county for a battery plant. And we said, no new development coming in, that seems like a great opportunity. But really, it's about growth and it's about a friendly environment. Hence, why we invest in the Sun Belt.
Cool. Yeah. Yeah. That sounds very interesting. And so you mentioned that both you and your brother are capital raisers. So what is the process for securing capital raising?
Process for securing capital raising. So typically it's going to take a couple different forms. I mean, the first thing with some of your existing investors, your larger investors, you're going to call them in advance of you launching a deal. Just, hey, I'll let you know this deal's coming. We're really excited about it, things like that.
Hmm.
And when we put something out to our investor list, we get a lot of people who, in the first day, the first week, whatever it may be, they're going to go into our investor portal and they're going to register a soft commitment. But other people, they're going to ask questions. I mean, it is a lot of just picking up the phone, talking through the project, why we like it, what are the risks, what are the strengths. It's just it's a lot of, it's not quite cold calling like it was in Marcus and Millichap, but you just call your investors. Have you looked at it? Are you ready to talk about it? It's just working the phones.
Yeah. Yeah. That's cool. Yeah. It sounds like you do a lot of touch points and then just make sure that they see the decks and they look at them and tell you what their feedback is, right?
Yeah, I mean, look, I know there are some groups that have a much more, let's call it, automated process where they put a deal out and they raise $10 million in 48 hours. But we really pride ourselves on how we work with our investors in terms of being available to them, walking through them, because we understand that these investments are a big decision. We're talking about at a minimum tens of thousands of dollars of someone's invested capital. We take that very seriously, and if
Yeah.
anyone has questions, I don't care if they're a $500,000 investor or a $25,000 investor. We're going to take the time of the day to walk through all their
Yeah.
questions, and make sure they're comfortable.
Yeah. Yeah. On that note, are you accepting capital from accredited and non-accredited, or how do you
Strictly
do
accredited,
strict
506C.
506C? Okay, great. And And who are your typical investors? Like what kind of like role do they have, and what industry do they work in, and you know just so we get a sense of like um, who you're helping out usually.
Yeah, so I know there are some groups out there where, they're like, hey, we help doctors invest, or we help this sect invest, we help that sect
Yeah,
invest. We don't have anything nearly that specific. We've worked with everyone from private equity firms to family offices to retiree. I mean, obviously it's real estate. We work with a lot of retirees. I want to say, I'm trying to think of doctors. We've worked with doctors. We've worked with lawyers. We've, we're not one of those groups that's like specifically targeting doctors or dentists to work with. We work with all sorts of people. There's no specific concentration.
okay, cool. Yeah. And how is AI changing multifamily right now? Is there anything that you see happening, or have you looked at anything?
So I understand that some groups in the property management side are utilizing AI bots to essentially serve as, I mean, they're essentially chat bots. So when people go on your property's website, they can ask questions, things like that.
Yeah.
I actually put out a question on LinkedIn the day before we're recording this, just asking people, I hear all the buzz about AI this, AI that, but I really would love to know a concrete example of what people in commercial real estate are doing to help them analyze more deals or whatever the case may be. And I didn't really get a solid answer.
Okay. All right. So I guess it's still in the works, probably.
I
Um,
mean, I think about it, but admittedly, I know I'm not the most technologically proficient person, which I should be based on my age, but I'm not.
yeah. You're pretty young, right? How old are you?
32.
32. Yeah. That is quite a ways, from a lot of people in the space. Yeah. So you also were part of the Low Country Veterans Home. What kind of experience did that help you in any way?
Well, I mean, Low Country Veterans Home is a homeless veteran shelter in Charleston, South Carolina. So that organization wasn't really there to help me. That was an organization where I was there to help them, and honestly, it still is a great organization. I served as president for nearly 3 years. We had well over 100 formerly homeless veterans. We were able to get them off the street, provide 3 meals a day, temporary housing, and then transition them into permanent housing. So it's a great organization. Um, it's a really great organization. They do great work. So that was really more of me giving back, not necessarily getting something out of that.
Yeah, yeah. So, how important is giving to you? Do you have do you are you actively participating in charities and doing that? Is that a big plan, like a big part of your values, or?
So I was very active in that charity for, like I said, almost, geez, was it over 3 years? I was very active in that charity for over 3 years. I actually recently just stepped down due to other time commitments, but no, it was because I was really passionate about, and I was able to help a lot of people along with the rest of the board. But I'm currently not on any charity boards. I've got my hands full with some other things.
Okay, cool. That's pretty cool that you were a part of it anyway. Mm, so let's talk about multifamily for a second. What do you see when it comes to demand right now? Do you see anything new happening? Like I heard of pad splits and some other kind of interesting, multifamily um, developments that are happening. Is there anything that you guys are doing that is like that? Have you guys looked at those options, to invest in?
I'm gonna have to ask a question. You said pat splits?
Yeah. I heard. I have a friend that has multifamily. He personally owns it, and he said that some people, some investment companies were looking at into getting buildings and separating them into pad splits, so they rent them by the room, basically.
Oh no, we don't do anything like that. That I've heard of groups doing that, but we are primarily our focus is like we want to run apartment complexes, treat our treat our tenants well, and deliver for our investors.
Yeah.
Nothing too cutting edge. No short term rentals, no pad splits, anything like that.
Yeah. Yeah, that's cool. How is it when being a broker? How can you give advice to someone that is wanting to start calling brokers and start getting deals sent to them in order for that to actually happen?
So I agree with I agree with Jonathan Twombly insofar as you cannot be using a Gmail account, get your own branded email, but I actually disagree with him. I do not think you should get a website. Uh, because if you have a website and you've never owned anything, you're just advertising the fact that you don't own anything. That's where we disagree. But when you're getting started, as I said earlier, you should buy smaller properties because it's typically a less efficient part of the market. And you might find something on the MLS or a smaller commercial brokerage, not necessarily CBRE.
Yeah.
But even if you're buying a 15 unit property, that 15 unit property, once you own it, it gives you more credibility when you try to buy the 30 unit or the 45 or the 100 unit deal. So it really stacks on to itself. But as far as as far as getting in touch with brokers, I always tell people you really want to concentrate on specific markets. You want to build relationships in those markets with specific brokers. What you don't want to do is you don't want to be one of these people who I'm looking in Atlanta, I'm looking in Georgia and Texas and North Dakota and Idaho and Virginia, and like you don't want to look all over the place. You want to build a network that is concentrated in a certain market so you're an expert on that market and you have very deep relationships. What you don't want to do is be a mile wide and an inch deep.
Yeah. Yeah, that makes total sense. Um, and when it comes to investors, what are some ways that they can vet potential sponsors and deals to make sure that they're going into a deal that is actually one that's going to be successful for them?
So, speaking at a high level, I'm going to give a plug for a new company that I'm actually a fairly big fan of. It's called Invest Clearly. I have no economic relationship with this company, so there's your disclaimer. But it's called Invest Clearly. Their website is goinvestclearly.com, which I'm not sure how they would characterize it, but it is essentially a site for people to review sponsors that they've worked with. You have to verify that you've worked with the sponsor by providing a K1 or some information relating to your investor portal, but they do force you to clarify that you are one of their investors. So it vets the sponsor, or it vets that the investor is real before they publish a review. So that's a great way for investors to gauge a sponsor and how satisfied their existing investors are. Still early in the process. It's only been around for 6 months or so, but I like where that one is going. As far as how to vet if a deal is any good or not from an LP's perspective, the specific deal, you want to look at the comps. You want to, especially in today's market, sales comps, I think, are one of the most difficult things because, I could be buying a property for $200,000 a door and I could point to some sales comps. But if those sales comps are from 2022, it's a totally different market than it was in 2022 or 2021. So you want to make sure they're up to date, they're recent. You want to analyze, it's saying the value add program is X, Y, and Z. Do I think any of that is really achievable? Do I think, a lot of times broker OMs will show you here's a 1970s property getting $1,000 a month, but here's this new property getting $2,000 a month. You have $1,000 you could gain in rent. That's not happening. You're not going to get
Yeah.
the same rent in a 70s product as you are in a Class A product, barring some super special location details.
Hmm.
But I mean, yeah, there are a lot of ways to vet a property, but one of the biggest ones I think of right now is just, what are the sales comps? What is your price per unit compared to what something was or selling for back in 2021 or 2022? is the value add achievable? Is revenue going up 10% in the first year? Or is it going up 50% in the first year? Because if it's going up 50% in the first year, that's going to be tough to pull off.
Yeah, yeah, I see that. And when it comes to the value add, how do you like? What's your typical way of doing the business plans?
Well, what do you mean by that?
When you look at a property and you say, okay, we're looking at this 1970s, and we see that there's $1,000 difference from the Class A properties. How is it? I've heard of people that they for example they renovate properties while maintaining a 90% occupancy or so. And what are the things that you do in order to make this happen so that you guys are continuing to getting the return that you want so that your investors are happy?
Yeah, so if you're buying a 200 unit apartment complex, you're never going to renovate all 200 units at the same time. That would involve emptying out 200 apartments or something like, which you just don't want to do. You're going to have natural vacancy occur. So when the vacancy occurs, you're going to want to go in, you're going to want to renovate the unit. And if you want to be very aggressive, you can not renew people's leases so that you can go in and renovate the unit. As to how we go about our value add, I mean, that's the case. We typically, when we buy a property, we want to finish our renovation scope within, let's say, the first 2 years of ownership so we can grow NOI at the property. We obviously, with most assets, we want to make sure we have a stable source of income, providing a return to investors. You don't want to go into a place and just flip it over completely. Part of the reason you like the diversification of having however many units the property is so you can still have income coming in while you're improving it.
Yeah. Yeah. What kind of interest rates are you seeing in the market right now?
For new debt, I've seen things as low as, if you do the interest rate pay downs on agency debt, you can get something into the high fives, where bridge debt can be as high as 10%. Depends on what type of loan you're doing. We're looking at we just assumed a loan that was 2.95%.
Nice. Yeah, that's a great, that's a moneymaker right
right
there. Yeah. That's incredible. And so I want to ask a little bit more about the investors. Is there a cadence of, once they're investing with you, that you communicate with them?
So, as I mentioned, every investor, they have easy access to us if they have specific questions, but it's typically the case that we used to issue monthly reports. It wasn't really that fruitful. There's just a lot of noise within a month. So we switched over to quarterly reports. So we give our investors updates on the property every quarter.
Okay. And what are your typical holding periods?
Historically, it's been very short. Historically, we didn't want to hold anything for longer than 2 years while we were building the track record I mentioned earlier with the 7 exits. Now we're typically modeling anywhere 3, 5, 7-year holds, things along those lines.
Okay, cool. Yeah, that is interesting. Do you think what do you think are some of the pitfalls that multifamily investors have had in the past that you're wary about, that you are not making?
Well, the obvious one is floating rate debt. I don't care how good your value add plan was. If you bought a 3 cap in 2021 with a floating rate loan, I don't care how good your renovations was. You're not outpacing 80% of your capital going from 3% to 8%. We've never been a floating rate loan. Like I said, we don't use floating rate debt, period. So that's, none of the deals where we're the lead sponsor have it.
Yeah, totally. And so is your brother also active on LinkedIn as well, or are you?
Yeah.
Okay, cool. And what kind of content do you guys post on LinkedIn?
My LinkedIn content can essentially be boiled down to anything about projects we're working on, my general thoughts on interest rates. I heard once years ago that if you can't think of something to write about, just write about what annoys you. So, I'll complain about inflation numbers and why I'm forgetting what it's called. The owner equivalent rent survey, I think, is really dumb. I think the Phillips curve is dumb. I'll publish a lot of stuff like that. Evan, very similar, just commentary on the multifamily market, interest rates, the Fed. Although I will say my brother does like to put out some good memes. Puts out some great memes, get a lot of traction. People enjoy a good laugh.
Yeah, that's cool. So what do you like to do outside of work? What are some of your
My favorite thing outside of work is to go home and see my wife. Always my top priority. If you want something that's a little more, vague or a little more hobbyish, I like to run. I ran track in college. I still try to run. I'm obviously not any good anymore. I really enjoy the NFL. I will pay attention to the NBA during the playoffs. I will not care during the regular season, but I really enjoy National Football League. So those are I don't have a lot of hobbies.
That's cool. Yeah. Do you mentor any people or
not formally? No, not formally. I don't. I'm actually. This is a controversial opinion. I'm very skeptical of a lot of people who do coaching programs. I'm very skeptical of a lot of it. I've had people ask me if I want to do it before. I know there's a line between coaching and mentoring, but I don't formally mentor anybody.
Okay,
I mean,
cool.
let's also be honest. I'm 32. There's somebody who's got more experience than me that someone could hire for a mentor.
Yeah, for sure, absolutely. There's people with more experience. You do have a good track record, though.
I think so too. I'm very proud of our track record, but there's a joke about a 25-year-old life coach. Like, how does someone who's 25 serve as a life coach? No offense to any life coaches out there. It's not an industry I'm intimately familiar with.
Yeah, totally. And so who do you look up to in the multifamily space?
Who do I look up to in the multifamily space? I mean, I'm just, at the risk of being really broad, when I look at the larger groups, when I look at a lot of other syndicators, I do see some problems with syndication. GVA is obviously in trouble. Tides is in trouble. I do think for a lot of syndicators, you can run into essentially a moral hazard when it becomes too easy to raise the money. You start seeing co-investments drop. You start seeing the co-investments drop. You start seeing the acquisition fees climb up from 2% to, in some cases, 4%. So, I mean, I really just, the people who've been in the industry, Crow Holdings is an obvious example, but the companies that have been around for decades that have built these massive portfolios. I mean, I'm here in Charleston. Greystar is an incredible company. Crow Holdings is an incredible company, but that's not one specific individual. It's just the fact that they've built such a long track record. So that's, we aspire to be large. I'm impressed by syndicators who have amassed hundreds of millions, if not billions, of real estate. But I also, there are a lot of syndicators who are in trouble right now. So sorry I didn't name like anybody specific.
No, that's cool. That's cool. Yeah, it just kind of gives me an idea of how you want to be, like. So yeah. So Will, I think it's been a great episode here. Where can people find you?
Easiest place to find me on LinkedIn, but if you want to see our offerings, join our mailing list, anything like that, the best thing to do is go to mathcap.com, which is mathcap.com. So that's the best. If you go on there, you can join our investor list, join our newsletter, anything like that.
Yeah, that's great. And do you have any parting words to anybody that's looking to become a multifamily syndicator?
No, I feel like we've already covered it. I really can't emphasize enough. I think you really want to start with the smaller properties. They build your credibility. It's less equity to raise, and it's less competitive in that space. typically. You know, when you go into a market and say, I want to buy a $20 million property and I've never bought anything before, you're competing with everybody who owns a $20 million property.
Yeah.
So
Yeah.
better to start on the low end.
Yeah, totally. That's great. And so thank you so much for coming on. I appreciate you. I will be looking forward to another episode in the future, seeing your progress. And congrats on this latest acquisition. It's definitely a big sized one. So hope it's good.
No, thank you very much, Julian. I appreciate you having me.
Awesome. All right. Well, thank you.
Bye.
Bye.